Right, this is a real practical session now, thinking about, from your perspective, how best to integrate the sustainability piece into the client journey, right from when you have that initial conversation with the client, through the suitability, and then, as we said earlier, that ongoing relationship. And we've touched on the kind of engagement and retention just then, but let's take that a bit further. So let's start at the beginning. You meet the client. Matt, do you want to kick off, introduce yourself, and just talk a little bit about what you do to kind of delve into client motivations and barriers?
Yeah, so hi everyone. I'm Matt Pitcher, Managing Partner at Altor Wealth. We're just a mid-sized Hampshire-based firm, big users of EQ. So in terms of the client question, the client engagement, we've always taken the view that we should be asking clients what they don't want to invest into. So we've flipped our questioning on the head compared with some other advisors that we speak to. So I think with what we're talking about today, clients come to meetings with views about terminology very often. So if you say to a client, are you an ethical investor? There'll be a value judgment that they'll make about that, and that as a label. So we started as part of the questioning and the onboarding, just asking clients what they didn't want to invest into, because that will give you a much broader range of responses and more personalised. Really interesting what Greg was saying about personalisation, because actually I think we're moving towards an environment where clients potentially could end up with very different, very bespoke, personalised portfolios. So.
And after you've had that kind of exclusion conversation, what's the next step in that journey?
Well, that very much depends on the responses, to be perfectly honest. So stories are so powerful, again, as Greg said. So some clients will want to exclude specific sectors because they've had a bad experience. You know, we've had clients who've said to us, I'm not an ethical investor, but you know, someone in the family perhaps has had an issue with smoking or gambling. Some really quite powerful stories that clients say to us, and under no circumstances would they want to invest in those sectors, even if they don't deem themselves to be green or sustainable or ethical investors. So our challenge was whether we could have solutions, research solutions that we could deliver to those people. It's super complicated, is the answer, because you've got to find something for all those people. Yeah. Obviously, the portfolios that you guys have got have helped us to address that, particularly with the launch of Climate Action, where that is the focus for some clients. So.
Great. Just coming back to you, Greg, flipping it on its head, using an exclusions first kind of process. What's your views on that in the wider kind of behavioural finance piece? Not to put you on the spot.
I think the only thing I'd say about that is it's good, but be careful how you ask it. Because if you give people an open goal and then you also pressure them to kick towards that goal, they'll do so. So if I go and say, give me the 5 things you want excluded from your portfolio, even if people don't feel very strongly about it, they'll come up with 5 things. You've then tied your hands quite badly because you now have to deliver them a really complicated portfolio. So I would say, try and make sure that you ask the question so that you are getting answers that are genuinely deep-seated feelings that people have, and don't encourage people to exclude more than they actually might want to.
Mm-hmm. Okay. Sian, do you have anything to add on that?
Yes, in between those two, as far as my question normally is, what does it mean to you? I mean, if they say they don't want to invest in ethical investments, easy. It's harder as soon as they say yes. And asking what does it mean to you? And then you get to know the client rather than the actual thing. I mean, I've had in the last 2 weeks, I've had no fur, no child labour, and inclusivity. And you don't necessarily from that need to go bespoke, but it gives you an idea of the measure of how passionate they are about ethical investing.
Okay. Just sticking with you, Sian, you've had quite an interesting story that maybe you can share about setting up your own business and your conversations with the FCA recently.
Yeah, so we started our application with the FCA at the beginning of this year. We finally got directly authorised in July. And everyone told us it's going to be a nightmare, but it was hard work getting set up. But what we were surprised at was we prepared a business plan, and one of the main questions in one of the interviews that the FCA gave us was, why have you not mentioned ESG? Why have you not mentioned environmental or ethical investments? Now, we came from, somebody who's here, Philip James, Financial Services, who was an early adopter of ethical investor, and it's in our DNA that we would always ask a client, how do you feel about ethical investing? Let's talk about it. So when the FCA asked us this question, why is ESG not in your business plan? We were a bit perplexed, and we said, well, we didn't put attitude to risk in our business plan either. But it's the same thing as far as we're concerned. But it shows just how much the FCA and how important it is as part of your business to be talking about it.
Great, good to hear. Roy, let's move on to you. As head of proposition, you're one step removed from the client piece. Can you talk a little bit about how you at Ativo support your large advisor base when it comes to suitability? So had the initial client conversation, what does the next step look like?
Yeah, absolutely. So we start with Oxford Risk. We've used Oxford Risk for a number of years.
We didn't plan that, by the way.
And that's where our conversation starts with clients. But it is the start of a conversation. So we are what we call lifestyle financial planners, which many are, but we're objective and value-based. So seeing a client having an impact desire and potentially apprehension, that allows us to then have the story. We then have to make sure we've got a suitable panel that, of course, sits at the end of that, so that we can cater for the spectrum of investment, that our financial planners are able to have those detailed conversations and potentially using documentation such as your own to help tell those stories. And I mean, longer term, it then has greater effects as well in terms of what we come back to and what we look to, and those values just become stronger and deeper entrenched.
And in terms of, you mentioned some of the EQ literature. It would be remiss of me not to focus in on that. Can you kind of talk a little bit about how that's used in the process?
Yeah, I think it's the storytelling. So we don't have a set questionnaire other than Oxford Risk. We we look to have those conversations and record those conversations with clients about what matters to them, what values they want driven in. And we then use measures of across the spectrum of investment of depths of green. So making sure the providers we use, such as EQ, are transparent. And if they're not as dark green, that's still fine, but they are able to be transparent about that. So then when it comes to something like EQ, it's having those stories that are there. So having those measurables that's not just performance measurables, but actually we can look at what climate assessments are being done, and having some of the literature you do, your quarterly impact reports are of course something we can go back to at reviews and tell that story. So we've got that evidence that isn't just talking the next year about your performance has gone down. Actually, it's talking about, well, you had these values, we've delivered on these values in a kind of non-financial sense, but also we've got the finance side of it as well, that your assets are still aligned to what you want to deliver financially, but also aligned to kind of your greater values of what you want to do.
And, you know, there's obviously a huge amount of data that's gone into the work that you've done, Greg. Some people are very data-driven. Any experiences of kind of more focus on the data, on the kind of the measurables versus the storytelling when you're engaging with clients? Sian, Matt?
Clients want positive returns, definitely. But usually if you, sorry to use the words of know your client well enough, you are able to say to them, but do you remember this is what we discussed, and the data, and the data and the stats do fall away. Once you say to someone about, I don't know, I've picked up the story from EQ on impact on mental health on Facebooks and Instagram and not investing in that. And the clients are just nodding away going, absolutely, we don't want to be part of that. So that storytelling can counteract some of the data, some of the stats that are coming through.
Anything to add, Matt?
Yeah, so clients are very richly different, bless them. So there are some clients that we just have to communicate with differently. There are some clients who only want a data set, who only want charts, they want numbers. And there are some that prefer stories. And we're just trying, we haven't got this right yet, but we're just trying to make sure we communicate differently with people. I think the risk for all of us as firms is that it's easier for us from a business perspective to communicate in one way. But actually that's never going to hit the clients where they need to be communicated with.
Okay, great. That tablet's not working, so I'm going to have to slightly turn around here. So let's go with, as advisors, do you expect to see the number of clients wanting sustainable portfolios to keep growing? Greg, you're not an advisor, but what's your take on that?
I do, and it's not because I think people are changing. Actually, the data that we've looked at over 5-10 years have actually been fairly static in terms of the series of the proportion of people who say that they are very interested or aren't very interested. The reason I think it's going to keep growing is the industry is evolving, the set of solutions out there is evolving, the ability for us to tell those stories is getting better. So I think we're getting better at addressing an ever-increasing pool of people who have those preferences anyway, but might not have raised them themselves, or we might not have been good at reaching them before.
Yeah. And I guess for that, it's about the advisors having the confidence to be able to have that conversation. How are your confidence levels at the moment compared to kind of 3 or 4 years ago?
I think we're going to have the conversation, because another part of that being directly authorised with the FCA, I had to write it down, I'm part of an early and high growth oversight team. And we were surveyed about 2 weeks ago, so we got authorised, they're now watching us, and we got a survey through, and we had to write several questions asking what percentage of our business, new and existing, was designated to ESG or ethical options. And we were looking up saying, well, we don't have the MI for this. We weren't expecting that to come through. So we've now incorporated a new tick box of who is going investing environmentally. And if you're asked to do that, funnily enough, you ask the question even more, and so it's going to grow. It's got to. It's the trajectory.
And Roy, you obviously look after the panel at Ativo. Mm-hmm. What are you seeing in terms of trends going into sustainable versus traditional portfolios?
So we've fairly consistently had about 20% of flows or recommendations go into sustainable ESG across kind of depths of impact. I think what we have seen is probably the darker green is where we're seeing more going, which is quite interesting compared to the kind of lighter green options, I would say, off the back of COVID and it being that kind of trend at the time it had. So still consistently 20%, but more going into kind of the darker solutions.
Great, good to hear.
Very, very quick point on that. I think people's quite immediate responses to particular terms fluctuate a lot. There was a time when you had to put ESG everywhere, and now in some quarters you don't want to use ESG at all. That fundamentally has not changed people's underlying preferences for leave the jargon out of it. Do you want your portfolio to reflect your values and have your fundamental values changed in any way? No. So I think it's about making sure our stories keep up with the lingo of the time, but people haven't suddenly become more or less nice at a deep fundamental level.
Good. Okay, I'm going to go with the highest vote here. How do you actually match investor preference to sustainable funds? If you do use EQ's questionnaire, now would be the time to mention it. Anyone?
Our compliance consultant brought us up on this because we have got a range from light green to dark green of options, and they said, well, and how are you matching these both on sustainable and risk? So we've had to go a little bit further into talking about, well, why? What are the reasons? What are the reasons behind that? And it's still a bit subjective as far as where we are, because you can't actually put people into the boxes that I think people would like us to put them into.
Let's just take that, Greg, to you. Subjectivity versus your depths of data.
I think it's both. The data can portray a nice, accurate, stable picture of who someone is, but that is an input into a discussion, not an input into a computer spitting out an answer. I mean, maybe 10 years down the line we'll be there where there's a full universe of investment things and it's just click a button and it matches. But right now, I don't think we are. I don't think that's the main value of the data either. I think the two need to work together, the subjective client knowledge and discussion together with the measurement and the data.
Yeah, perfect. Okay. Do you see SDR as something that will help matching clients with investments? I did promise that I might not touch on regulation, but Roy, where's your stance?
It could have been, maybe. If it's done correctly, yes, potentially. If you're able to use those boxes a little bit more and kind of drive those preferences, then yes. Where we are at the moment, my thinking is probably not. I think you'll end up with too much in one box and you'll then have to work out what you want from that box as opposed to being able to cover impact, sustainable. So I think it could do that, but I don't think it's doing that yet.
I guess what needs to happen after we get some conclusions on it is to see a bridge between the questions that you're already asking and the infrastructure you have and the SDR labels.
Yeah.
And also those little, as you're digging into detail and you get the no fur or whatever, no child labour, if you go too far down the rabbit hole, you just end up with bespoke portfolios for everyone, which is going to become not in the client's interest necessarily because it's going to be more expensive, more time consuming and less able to match that against, to look at performance.
Yeah, so I'm a big believer that technology may help us here, to be honest, as advisors. I think you're right. I think it isn't there right now, but it is coming. I fundamentally believe that. If in the US, if you want to go and get a bespoke portfolio, you can do that incredibly efficiently, incredibly cheaply, and you can specify every single, down to company level, what you don't want to invest into. That's come to the UK. We've got custom indexing now in the UK, and the just a little bit that's missing is between all of this we've been talking about around investor preference, and just that little bridge across to what is perfect for that individual client. So I don't think we're that far away, but I think it does need a little bit more work, and hopefully there's still a little bit of space for the advisor in there as well, and it doesn't become fully automated on the way through. But actually, all the people in the room, we don't reach the majority of people with money in the UK, because the majority of people in the UK with money, that they can't access, they can't afford us. So there will need to be, and that's probably where SDR may help, there will need to be some slightly more vanilla, easier routes to investing.
Nice. Lovely. Okay. This one's totally off-piste, but let's give it a go. Sustainability does not have anything to do with values, rather survivability. Discuss. I don't know how that got through, but it did. Anyone? Go on, Greg.
I'll take a tilt.
Here we go.
I mean, I think it depends what you mean by survivability, but a lot of people, I think about, there's this whole risk lens on ESG, and the claim is that ESG doesn't have to be about what you want or what your preferences or whether you care about the planet or not. It's just looking after certain things that might decrease the value of your future investments because floodplains, because global warming, etc., is a really good thing to do investing-wise, and therefore looking after the survivability of your assets is what ESG should be about. I think that falls woefully short of what most investors think of when they think, is this thing sustainable to me? Does it? I mean, people do have preferences. They don't want to invest in things that are leading the world into a flaming inferno, etc. So there's definitely that element. I think it is entirely sensible to think through ESG characteristics through the lens of, actually, is this going to be harmful to the value of my portfolio in 10 or 30 years? But that's not all there is to it.
Absolutely. I mean, the financial materiality point for us is hugely important, you know, as important as also bringing someone's values into it. You know, I think, I don't know who wrote that question, but you've got to be careful that you don't land on the side of evangelical and preachy when you're talking to kind of clients who are thinking about their investments but also have a financial motivation.
But actually, ironically, I think the clients are probably ahead of the investment management industry. If Greg's data's right, we're nowhere close to 2/3 of clients being invested sustainably. And so I don't think the clients are the problem here. I think largely it's the investment management industry, unfortunately, with obviously the exception of everyone here, just to be clear. That's not to, well, that's to keep friends. So it's not going to take a lot if we can find a way to unleash the latent desire for sustainability. If we can find the way to deliver what the clients want out there in the mass market, I mean, a lot of this falls away, right? It becomes the norm, and then what becomes unusual is to want to invest in fossil fuels or tobacco or any harmful practices.
Can I just say something? Because I don't think that's off-piste at all, actually. I think it's a really sensible question, because the wider narrative, we are heading for real planetary breakdown. And I think for the investment industry not to take note of that is a serious problem. So I think it's not going to happen overnight, but I think the more that investment managers will, you know, roadmaps, proper robust roadmaps to net zero, that is critical. So I think it's a great question. I didn't write it, by the way. And I think, you know, we've all become a little bit complacent as an industry. So, you know, I think we need to be bolder, and we need to take these steps. So, you know, I think it's a warning sign. I think, you know, we underestimate how much some clients are really worried about the situation, and the huge disconnect that there is now between the way a lot of the financial services people talk and what's happening outside. So, sorry, I'll get off my box now, but
No.
you know, I think don't underestimate that question.
No, I think you're absolutely right. And just quickly, there is the one thing that's going unsaid here is advisor preferences. And when I'm in groups that aren't quite as forward-thinking as this, some of the things I hear advisors saying shocks me. And they're imposing their own beliefs and attitudes and objectives on all of their clients. And that does worry me. Hopefully, with some pressure from the regulator and labelling, that may improve, but not everyone, I suspect.
So that, you know, that leads on to a nice final question here. Many advisors are avoiding the subject, preconceptions, lack of knowledge, have their own beliefs. What can we do? What are we going to do to push them forward?
I think what most of us do anyway, which is have a discussion. We're not order takers as financial advisors. We go and talk to people, get to know them, understand the why. Why are they investing? What's this all about, and what's it for? And having that conversation, just it does bring you into a conversation that's much wider of this is what I'm about and this is what I need, and talking about just their own desires. And I think that's where we'll move it to.
Having been critical of advisors, I'm going to jump in and row back slightly. I think most advisors I speak to don't ask the question because they don't know what the answer is. So actually, as much as we can try to preach to the unconverted, there needs to be a broader, easier to access toolkit. So EQ being a good example. I think once advisors know what the answer is, they'll start asking the question.
Great. Okay. 30 seconds. Can you each give one quick tip for the audience on how to support clients through the sustainable journey? Very quickly. Roy.
Transparency. I think you have to use providers that are transparent, and you're not worried about using them.
I'd look at your data for how many people have got any form of sustainable screen, and benchmark that against what the broader population stats tell us.
Nice.
I'm going to change mine on the spot here, but my one, because it's not been mentioned, is your case studies. Read those. They come out, I think, every 6 months, don't they? Or the ones about what these funds are actually doing, real life stories, how a water company is cleaning up the water in the Thames, how a bank in Indonesia is helping farmers who can't afford machinery, and using those and talking, having that as part of the conversation, because that's what we can offer that people don't know.
Great, thank you. Quarterly, they come out just
Quarterly.
everyone's noticed. Great, okay, lovely. Sian, Matt, Roy, Greg, thank you so much. And yeah, thank you everyone for a very interesting first half. We're going to take, I think it's 15 or 20 minutes now to have a break. I challenge you all to come up with a concept or a theory where you can include Spock and Tolstoy in the same conversation. And yeah, thank you again to all the speakers.